Is the Fed there yet? I don't think so. Pat Harker from the Philadelphia Fed, said he sees maybe one more this year. I think the thing about the yield curve, too, you have to remember, it isn't necessarily that it causes the economy to slow down. I think the idea is there's a correlation. It has preceded it. But once it does flatten or invert, what does it do to banks? There's been research also at the Fed suggesting that it's not just this question of a signal. It's not just a question of investor expectations. It can have a real impact on the economy because we've seen it big time in Japan. If you've got a flat or inverted curve, that's not good for banks. So there's many elements to this. I would say right now it's one thing the Fed is watching. Will it spur a rate cut? No. The economy, inflation, as Charlie Evans said, are going to have to verify that move.
And Mark, let's get to that other top story we're watching, which is Samsung here. I see shares down about 1% in Korea here today on that surprise profit warning. This coming at a time when we thought chip stocks were coming back, that the bleeding was over. Is this just a Samsung-specific thing?
It probably has a lot to do with them in particular and the fact that they're so close to the Chinese market as well. They're still being caught up in this trade war between the United States and China, so that is certainly affecting it. But it does send a warning signal for everybody. Samsung is a global player. There's no question that they're in every single part of the consumer market around the world. So there will be people shuddering to think that what it could mean for other similar companies around the world. So it certainly has some impact for other people. There's also a bit of expectations management going on here because Samsung wants to get ahead of the results. It wants to get people thinking that things are not quite as exciting as they have been. And the stock's been up a long way this year already. So it's a good time. If you're going to do a warning, it's much better to do it when your stock has risen substantially than when the stock is already on the way down. So there's quite a few elements to this story. Maybe it's not quite as dramatic as it originally seems, but certainly, yes, there is a warning element here for everybody in this movement.
Mark, just on Brexit, the UK Parliament has temporarily at least taken over some of the decision-making. To what extent is that a potential positive? Does it reduce the risk of a hard Brexit?
No, the risk of a hard Brexit is still very much there. There's going to be many options put forward this week, including maybe a second referendum or even removing Brexit altogether. The thing is that Parliament has found it very, very difficult to agree on anything. There is still the possibility that by April the 12th, they have still failed to pass a single alternative to Theresa May's deal, and that would mean a hard Brexit. So, yes, the odds of a softer deal have certainly improved. With the vote that we had on Monday in the UK Parliament, there is more chance that the proposals being put forward will offer a soft Brexit. As to whether or not Parliament will actually agree to one of those really is anybody's guess. Right now, everything is on the table, and yet we could still have a no-deal Brexit. It is not an inconceivable possibility.
Mark, thank you. Mark Cranfield there joining us from MLive. I also want to thank Kathleen Hayes, our global economics and policy editor, joining us from New York. Let's get some more perspective on this. Joining us now is Philip Wyatt, APAC economist with UBS Global Wealth Management Chief Investment Office. He joins us here in Hong Kong. Philip, great to have you. We have significant portions of the curve now that is inverted. We talked about the 3-month and 10-year node. If it's not signaling recession, what do you think it signals to you?
I think it signals a period of softer growth. Made some very good points there about the signals that you can glean from it, but I think it's important to bear in mind that when you look across the world, growth and activity is a little bit desynchronized. So you have the EU, which is struggling to get back up again. You have the US, which is in the early stages of a moderate slowdown so far. If you look at industrial production, for example. When you look at China, they've been stimulating very significantly, and we're expecting that to result in a lift in growth there. So the signals are a little bit mixed, but in general, I mean, us, like many, are expecting a slower year this year compared with last year. That's key, but not recession, no. So it's premature to talk about the yield curve meaning that we have to go to a recession.
Right. It's just one of those things that has to fall in place, not necessarily, of course, leading to that. Worst case, though, if we do get a recession in the U.S., it's been a while. You had, of course, during the crisis, which was a severe one, you had the early 2000s, you had this recession affect the world the way it once did. Is it really that bad for the rest of the world, is what I'm trying to get to?
That's a big question. Well, it depends, is the honest answer. I mean, not all recessions are the same. Some are driven by the housing collapse, some are driven by too much debt on the consumer. I mean, in this particular, at the moment, we don't see strong signs of a recession, occurring in the US. But, with any anatomy of a recession, if you like, you need to look at what the causes were and whether you see any big fragile sectors involved. And at the moment, you were just talking about the IT sector, for example, globally, which is going through a little bit of a downturn. I mean, aside from that, there are no sort of really significant sectors in the US economy which give us an indication that the US as a whole is going to go into recession. So, yeah, that's where we stand on that. But as I say, each recession is different. I don't think anybody would argue that the global financial crisis was didn't have an impact, on the rest of the world, right, to your point. So let's see.
Philip, it's Tom here in Beijing. I wonder if you have a sense that bond yields are actually decoupled from growth. If you're looking at a 10-year at 2.4% or a little below 2.4%, but nominal growth at 5%, does that suggest that bond yields have decoupled from growth?
That's a great question. It's one on everyone's lips at the moment. I mean, the bond market has always tried to look forward, or financial markets in general, but bonds specifically, they're looking ahead to try and see just how soft is the economic data going to be coming out of the US. And as I said, at the moment, if you would look at the hard data, like the industrial production side, like the consumer side, we are seeing signs of softness. But it's not extreme. And the bond markets are feeling their way through to just see how far can that trend continue. The policymakers have reacted, as we heard last week, with the Fed showing greater commitment to a longer pause. We as a House are looking for no moves this year in the Fed funds now. So, let's see how things move on. And as I said, it's not just a US question. What happens in the rest of the world is also important too. We're optimistic that China, for example, can lift itself a little this year. The EU too, I mean, should be able to find some form of stability. And all the while, we have a monetary policy outlook which is showing signs of relief. So the Fed is giving Asian central banks cover to either cut rates, go on pause, or at least show some dovish bias. And this is going to be supportive out here.
Where along, if you do want to position, Philip, into treasuries, US treasuries, whereabouts on the curve do you want to be at this point?
Well, that's a great question. I mean, for a while, we've looked at it as if you like, a hedge against a more serious decline in activity.
Right.
But it is possible for the long end to run too far, too fast. And it's not clear to me how much of this is cyclically driven and how much is driven by other expectations. For example, as the Fed winds down its balance sheet, right, its composition between mortgage-backed securities and US Treasuries will change.
Right.
And so that itself may be something which is also weighing on the minds of temporary traders. So it's quite hard to distinguish some of these factors.
Should we ignore inflation as a gauge of growth? Because bond markets look at inflation, the Fed looks at inflation to judge what they need to do.
Yeah.
But that relationship is broken down, which is why, to Tom's question, it's a bit out of whack.
It seems a bit out of whack, yes. But I mean, as I said, the bond market, these things are not always marching together in step, right? There's a question of lags. So the bond market is looking and testing to see how soft the economy is really going to end up becoming in this case in the US, right? In the meantime, inflation tends to be a slightly lagging indicator. So yes, so we think there's going to be perhaps a little bit more immediate softness there in pricing power. We're seeing that globally as well through PPIs, for example. The economy itself, as I said, is in a sort of early stages of a moderate softening, if you like,
yeah.
And it's punctuated by the impact of, if you like, an inventory correction because of what's going on in the international trade environment, right? We see that in Asia too, by the way. So that's not, an inventory correction is not permanent, right? It happens and then we move on. And these are temporary factors which can lead to quite, I agree with you, it seems to be a little bit out of proportion in terms of the move in the long end of the curve, but we'll have to see where the economy stabilizes. And what will differentiate people and investors' views is whether they look to half two of this year to be further softness or stabilization. And we're in the camp that sees that as a more stable picture at the moment.
All right, Philip, stay with us. We'll have more from Philip Wyatt, their APEC economist with UBS Global Wealth Management Chief Investment Office.
Yeah, let's get it over to Sue Keenan. She's in New York for an update of our first word news. Sue.
UBS Global Wealth Management's Philip Wyatt. He's still with us out here in Hong Kong. It's interesting. I was looking at your notes here, Philip. When bond yields are tumbling worldwide, you have a call here, at least your house view, that Chinese bond yields could shoot up 20 basis points higher in the next 12 months or so. What's driving that kind of call?
Yeah, no, it seems out of consensus, but let's not forget where China's come from, right? The last 6 months, it's been slowing down. We've had earnings downgrades. The economy's been weathering the effects of the China-US uncertainty. And now we think we're bumping along the bottom, basically. I don't think you can expect China to inject such a lot of liquidity and promote the fiscal easing that they're doing without it having any impact on the real economy. So we are expecting fixed asset investment, particularly in the infrastructure side, to do much better. And this is going to change expectations. It may not seem that way today, but over 12 months, for sure. So that's one factor. And I think that limits the downside for bond yields, let's put it that way. And, you know, depending on how strong we see the pullback, that can move up. Second, there's supply. So with the credit easing, we're going to see more issue of bonds to fund it. And some of those demand-supply dynamics could also lead to slightly higher bond yields. So this is not an inflation-driven story in China, right? This is basically a story of supply, a story of moderate recovery in China.
Does demand pull those yields back down? Because there's also this inclusion that's taking place with the bond indices starting of next month. And one of your colleagues, UBS, granted, of course, it's a different unit, Hayden Briscoe thinks that yields actually push lower, might even be below the U.S. 10-year.
I mean, is there enough supply out there to meet that demand, potentially?
Yes, yes, it's a balance, for sure. I mean, I think you have to distinguish between what is basically a 12-month call to say that don't expect bond yields. What we're saying is don't expect bond yields to collapse, you know, tremendously from here. We've already come down a long way. Absolutely. Yes, there are structural factors, completely agree. The demand factor, as you point out, we may sink a little bit more before rising. But, I mean, about now, for China, it's probably, we should start to think about not to chase it too far down, right? There's a lot going on in the world, right? We talked about the US and how we have the opposite thing going on there a little bit. And in the region, we have also seen a pretty handsome local bond rally. And there's a little bit more juice in that too, partly because the region is behind China. China is well into its easing, but the region is kind of only just starting with India, maybe the Philippines next, and perhaps we can go to Southeast Asia a little bit more. But, you know, generally speaking, I'm saying this to point out that they're not all in the same position, right? And China is ahead. Yeah.
Philip, Tom here in Beijing. We saw a record sell-off, as David said, of foreign investors in A shares yesterday, about $1.6 billion worth. I just wonder if you think that is a trend that's going to be sustained given the current environment, or are the moves around things like the MSCI inclusion, but also the bond index and the wider opening up of the capital markets going to counteract that and continue to make this an attractive place to invest?
It's tricky. There are a lot of factors, as you allude to. We still think China is going to be a wonderful place to invest. We have a turnaround in the cycle, as I tried to point out earlier. We have the structural factors, the opening up of more and more channels of inflow. We think that, you know, as part of any trade deal, there will also be some move up in foreign direct investment as China opens access to foreign companies. There's a lot going on the stage in China at the moment, and net-net, we continue to think that it'll be plenty of opportunities for further investment. So, yes, there is volatility in the equity markets right now at the moment, but this is a good opportunity for investors to take another look, have a look at the valuations and the long-term outlook, and ask themselves, you know, whether they think this is going to extend into a trend, which we would doubt, or it will, you know, melt away, and we will move into another era, if you like, of more stable growth. I think we're close to a point of inflection in some ways. Yeah.
I'm curious, Philip, what your views are on the yuan. The PBOC, again, trying to stress that they want to make it a more market-oriented currency. Is that getting traction for you, do you think?
Yes, it is. I mean, the CNY has corrected quite a bit last year, and this year we've seen it move back up, if you like. I don't think it's a one-way street. I mean, the central bank wants to permit more two-way movement, more two-way flow. That's a healthy thing. But they're not going to remove, you know, the lid off the pot completely and allow it to move too far in one direction. So if there was to be further upward pressure through the balance of payments, let's say, I think we'd see them start to accumulate foreign exchange reserves rather than let it continue to appreciate. But you know, the CNY story, I don't think is the main sort of story. I think it's piggybacking what else is going on, which is, you know, the economy and its turnaround story, the Sino-US trade deal, which we think will come through somewhere perhaps in the second quarter of the year, and other factors like this, which are the turning factors. You also had a large discussion on the IT sector and what's going on there, and there is a little bit of an inventory overhang in the markets in some of these, particularly the IT-heavy economies, and that's working its way through. So we're, in some respects, at the worst point in Q1. If you look at trade, if you look at industrial production, I mean, in Q1 for Asia, these are pretty much a write-off.
Philip,
but it will improve.
A lot to watch,
we'll get the inflection in Q2.
Yeah. Yeah, a lot to watch, as you say, including, of course, trade talks, which are expecting to kick off again or to restart here in Beijing later this week. That is Philip Wyatt, APAC economist with UBS Global Wealth Management Chief Investment Office. Now let's get out to Sue Keenan with the First Word News. Sue.
All right, thank you.